I thought we would go to our to overseas investors first and get their view about what is it that's bringing your capital into the UK.
Well, the first question is obviously why would a pension fund invest into property? That's the harder question I don't need to answer, but it's a 120 billion fund. It's obviously the savings of the Canadian pension system, and obviously a fund like that needs to self-insure by investing abroad, because if the Canadian economy is doing well, we're getting a lot of contributions. We're taking 9.9% of every paycheck up to $40,000. So therefore, if the economy is going well, we're getting a lot of contributions, and therefore, we should be investing abroad to kind of diversify our risk. Why do we do property? We think it's a stabilizing factor. Property is today 5% of the total portfolio. And then within the property portfolio, obviously, we want to build positions outside of Canada. How much we diversify and where we diversify to depends largely on the investment environment in those countries. What we really like about investing in property in Canada is that we're tax-free, we're a Crown Corporation, and we're a privileged investor in Canada, similar to what other investors are in their home markets. What we like about some other markets like US, UK, and Australia is that we are very tax efficient with our investment. Compared to the high tax countries, we can get similar returns, but with a different profile, of course, to Canada. UK is, for us, a key market. We like the main food groups. We like shopping centers first, office second, industrial third. Most of the investment is going, indirect, via co-investments. So, again, UK has a very broad group of partners that we can team up with. We are not asset selectors, we are really partner selectors. And therefore, having a broad, very professional, local investment environment really helps us. So that's the main reason why we are so big in the UK.
The simple answer would probably, we used to do it, probably a little bit too simple, but the real story is that the first country outside Germany where we invested was really the UK, 15 years ago. In the meantime, 80% of our portfolio is outside Germany, and the UK is, as well as Paris and Germany, the most heavy allocation in the European portfolio. 23% is allocated to the UK. Why we do so, I think some factors were already mentioned by Wenzel. Added to that, it's probably the sheer size of the market. Liquidity certainly is an issue. The lease is favorable to the landlord still, even it's certainly a little bit worse than in the past, but still in comparison to many other countries, still in a very good position to the landlord. Then the risk profile is still quite good. The overall professionalism, transparency of the market, it's what attracts us. So we feel quite happy with that, with the overall portfolio. But on the other hand, are we interested to move that up to 50%? Probably not. So we feel quite happy with what we have there. Opportunity driven, we will certainly add something. We will probably sell something as well. But that's the main reason that we feel very happy in the UK market.
Okay, thank you. How much of this international money coming in is going beyond the M25?
Not much. We are seeing, obviously the German funds have been involved in the market outside of the UK, outside of the M25. But I would say that of the 80 to 90 overseas investors we believe are very active in the UK right now, 95% of that is for central London, long-let core plus buildings, where there is a safety net effectively around it.
And would you say that's the same if you took your international clients to Paris or Munich or Tokyo? Would they be absolutely fixated on the core central markets, or do they look beyond?
my personal view is that the last 18 months has shown us that we need to look at only the core markets and prime real estate, because that's been the most defensive, and that's where you can see an exit. Even if you're in tough economic times, there will always be demand for those cities and the best buildings.
How are you looking at the UK in terms of what exposure you would want? We've agreed that we all want it for the diversification. Now, how much? And aligned to that, what sort of return profiles are you looking for across your global portfolios? If there is no real benchmark out there, are you just chasing a liability number or an absolute return? How's it working?
And just speaking first of all on behalf of sort of UK institutions, because one of the trends that we're finding at the moment is that a lot of our UK clients who are looking for global exposure are going the way of John's business and using multi-manager routes to get their access to the global real estate markets, but they're sticking to a UK direct approach for the UK. Now, whether that's, again, for a lot of the reasons that we've outlined earlier in this debate, as far as what sort of percentages the UK should be in any global portfolio, again, it depends as to what risk strategy you're adopting, what returns you're looking for. As far as UK institutions, typically on the sort of portfolios we're dealing with, and I'm talking really only about the UK, I'm not up to speed with exactly what returns they'll want in Asia and beyond. But in the UK, typically there'll be absolute returns, and a lot of our clients actually look for a real return now, somewhere between 4 and 5%, and that's on the sort of core plus end, obviously. I think the other day I was looking at where people were pitching sort of value-add strategies, and again there with much more moderate gearing, you're talking sort of 9 to 11 as a range, and even opportunistic targets, which have always been north of 20 or around the sort of 20% mark, with sort of leverage of 65, 70%, they're now talking 14 to 15%. And I think that what we've all got to get used to is a much, over the next 10 years perhaps, a lot less expectation of higher returns, a much more steady, consistent performance from real estate. I think that if you go in to do that, then the likelihood is that there will be certain markets, whether it be UK or in global, where you may be able to outperform those more conservative returns. But that's what we're seeing at the moment.